Okay, what kind of strategies? Again, guys, remember that whatever strategies I'm showing you right now, so you have to think yourself based on your education level, so your understanding of strategies, and of course your money management techniques. That's your money, so think twice before you do it. If you don't understand something, it is better if you put it on simulator. Try simulator first, and then already when you feel that you're working fine, you're making money on simulator, open real account and try to put real money. But if you feel confident, right, so use the strategies which you understand. And I put here a couple strategies, few strategies, and I'm going to show you. It doesn't mean that you have to use all of them. You can choose any of them or don't choose any, and you use something else. Okay, if we buy a long-term hold strategy, so we can look at $96 or even 90 if it drops more. Like Ali said, we might buy now, some at $96, some at 90, and then hold it until 120 and $140 or above if it goes above. Possible waiting period, maybe 2 years. Hi guys, can you hear me now? Perfect, perfect. Technology. Remember, I'm in Russia, right? You're in Australia. There are a few oceans between us. Okay, great, great. Okay, so if you use this strategy, it's just long-term hold. You might have part of your portfolio in this conservative investment. And remember, you don't have to buy 100 shares if you just buy it for long term. You can buy for whatever amount. You can buy 10 shares only for $1,000 and keep it. Okay, for long term. Now, if you roll strategies, so you buy shares and sell shares, you just use technical analysis. And like as many of you said that you would buy at $95, $96. So if you buy it at this level, and then you might sell it. I put the price here 104.8. The reason why I did it, I just show you. Let's see, just return. Because if it goes back, whatever was support before, it might become a resistance. Okay, so this is $104, and if it breaks through, it will close the gap somewhere here. That would be another level of around 108, and then it would be 109. So if you do these rolls, so you might sell it at here, at this level, or higher. So whatever you prefer. But you have to keep an eye on that level. Now, regarding the trading right now, if you trade with stop losses, using rolls, sometimes it's quite difficult because volatility is so huge. Market makers, what they do, they kill your stops. For example, you look at the price is $99, you put a stop at $97, and then you can see 1 second drop to $97, your shares are sold at $97, and then the share price back again to $99. Okay, so quick it happens that you won't be able to react on that. Okay, so that's why daily traders, they're really crying right now when you do something like that, because they have to trade without stop losses, which is also dangerous because the share price might go quite low. Okay, so let's have a look at option strategies if you understand options and want to work with them. Now, first, buy and rent strategy, very simple one. So you buy shares at current level, which is $99.75. But remember again, so it's much better if you buy shares when it drops. So if you identify the price at $96, so it's much better if you buy at $96, and when it grows up to $104, then you sell a call. Okay, so in this particular case. Now, but for this purpose, for example purpose, I am going to show you how you do it right away. So what we do, we buy shares right now, 99.75, and here I put two only strike prices, one at the money and then in the money. Why I put in the money? Because if you're afraid that the share price might go to 96, or you already bought at 90, so like $96 level, and now it's on the way up, you might sell in the money and collect all the intrinsic value which it has. Okay, so in our particular case, first example, if we get $1.85, it gives us about what? $1.85%. like a month, right? It's 31 day. So it's not that much. So this specific company is not affected by the market, and it's not volatile. So that's why option premium is quite low. And that's why we're going to look at buying option instead of selling them. When the volatility is low and the premium is low, we might consider buying option instead of selling it. But we're going to get back to that. So if you do something like that, your profitability on an annual basis would be about 22%. So you buy safe, secure stock, you sell the call, you get it, your average price goes to $97.91. So even if you kind of are on at the current price, you're reducing your risks by reducing the share price, break-even point. If you're selling in the money call, okay, you're getting $5 in cash, $5.05, and if the share price exercise, so it stays above $95, your real profit is going to be only 0.26% a month, okay, which gives you around 3% annual. So it's not that much. But if the share price drops below $95, okay, you collect all the premium. So, and you reduce the cost of your shares to $94. Okay, so it's again, that would be for conservative investors who are afraid that the share price might go to $90 and they want to like reduce their risk. Okay, so now is it clear, especially for new guys who just recently finished the program? Okay, great. Now that's about puts. Again, you need 100 shares here. Okay, so it means $10,000 at least. Now puts. So instead of shares, you can offer to insure the counterparty and tell them, okay, I'm happy to buy shares, for example, at $100 level here and here, and within next month or here 24 days, if the share price below that level, you can sell them to me at $100 level. Now remember, you use this strategy only if you're happy to have the share at this particular price. Never use this strategy if you don't want to own the share or you don't have money to have. Because in reality, in order to use this strategy, you have to have 50%, or actually not, in Australia you can't. You have to have $10,000. If you lived in Russia, you need only half of the amount because they allow you to use margin. For example, right now, if we do sell put with $100 strike, so we promise that we buy shares at 100, we can get $2.34, 33 cents for 24 days, or $2.58 for 31 days. You can choose it yourself. So you can see here 233, 255. Break-even price, the price of the share, if we bought it, would be 97.80 here, and 97.55 in the second case, right? And if the share price goes above 100, so we don't buy shares, that would be our profit on kind of allocated capital, 2.3% and 2.6%. So which gives us around 38% profit and 30% profit in the second scenario. Okay, you can see the differences here. So sometimes it's better to sell puts and sell calls also for shorter period. Okay, so instead of month, we sell it for 24 days, but make sure that after that you have to sell it straight away without waiting a week. Otherwise, you will reduce your profitability. And if we choose $95 strike price, so for example, you're sitting on cash now and you think, I would buy it at $95, I wouldn't buy it before, but you're not kind of sure it's going to go to that level. So instead of just parking your capital, your cash without any use, you can sell and generate 82 cents, okay, which give you 1.7% return on, okay, so it's probably not 1%, 0.8%. So at least some kind of cash which generate 10% annually. And still you have a secure that you are not going to buy shares at $100. That's kind of strategy which people use if they are not confident about the market, but still want to buy that share. Okay. Is it clear about that strategy, guys? Put pluses if all right. Okay, great. Now, and another one is buying calls. I know I told you before that don't buy calls, but I know that some of you do buy calls. So that's why I'm going to start showing it as well for on our master classes. But again, if you never have done it, even don't go there. Okay, so if you don't understand how to buy calls, because buying calls, remember that you're risking all the money which you're putting in trade. You can lose 100% of the cash which you're putting here. But I'm going to explain in this particular example how you do it. So for example, instead of buying shares at $99.75, you can buy a call. I specifically put LEAP call, so it means long call. It's not for 1 month, it's not for 2 months. As longer you buy, the better, because in your case, what you promise here that you buying, you're happy to buy the shares at $100, and you paid for this $6.95. So what's the break-even point here for you? How much share has to grow in price, and like on the last day, in order for you to make money? Correct, $106. So if it stays below that, you're losing money. If it stays below $100, you're going to lose all $6.95 completely. And it can happen. Okay, so that's why you never put all your money, first of all, in this trade. You put not more than 5% on your account. So for example, if you use one contract right here, it would be $695. Okay, and you do it if you have a portfolio of $10,000, so not more than that. Okay, now what happens here, if you do this trade, actually you don't keep it until the last moment. You sell it way before that, and I'll explain you why. Because what happens with this call, with the price of call, when the share price rises, who knows how fast it's going to increase in price? All information is in that slide. So if the share price goes to $1 up, how much extra we're going to get? How much more the price of the option become in cents? Who tell me? The answer is here. Correct, Dory. So there is some kind of, it's called delta. So when the share price goes to $1 up, the option price goes 51.8 cents, like 52 cents up. So what happens that here we'll see $6, like bid would be $6 and what, 47 cents, right? And here we get $7.47. Do you understand that? So if we bought it for $6.95 and the share price went $1, I win profit and still loss, because if we sell at bid price. So how much in dollar volume share has to grow, how many dollars up, in order we to become break even? Like roughly, it doesn't have to be exact. Not $12, no. So when the share price goes $1 higher, the option premium goes 50 cents up. Correct, Dory. So if it goes to $2 up, $2 multiply by 0.52, okay, 51, let's say, we get $1 in 1 cent. Okay, 2 cents here. Okay, and it means if we bought it at $6.95, the bid will grow up at $1. So the bid ask would be $7.97, and the ask would be $6.97. So if the share price goes to $2, we actually would be able only to sell at the same price we purchased it. Understand? That's why right now it's so difficult to trade options, because this spread is huge. Who gets all the money here? Broker. Broker makes this dollar. on your trades. So that's why when the market opens, of course, try to bargain. Don't put, I buy at 6.95, start, I buy at $6, and then build it up, $6.05, $6.10, and see, maybe broker will be, okay, get it, and will give you the opportunity to buy at a cheaper price. Okay, always bargain. Don't put it in the market, otherwise you'll pay the highest price. Okay, do you understand that? So how I calculate here, so entry share price, that's why I buy at this level, I buy the share, or not the share, buy this call option, I pay 6.95, assuming that I pay 65, maybe I'll get it cheaper. Then exit share price. Remember I was telling you that, okay, I'll go back better there. So you can see it's my goal here at previous support. So my target is going to be there at this level. How long do you think it might take for the share goes to this level? Based on its volatility. Could be really quick. It could be a couple days. It can go there and then return back. 4 or 5 days. So very, very fast. So it doesn't have to be really long trade. Okay, and what we see here. So if I buy at 6.95, okay, delta is 52 cents. So, and it grows up by how $4 and what? 75 cents, right? If we assume that delta always going to stay the 52 cents, it's going to increase, by the way. It's going to be bigger. So the real profit would be higher. So that's a conservative outlay. So if I know that the share price is going to be $4.75 high, I multiply it by 52 cents. So roughly, I'm getting like nearly $2.50, like less than $2.4 in profit. But because I'm going to use bid price to sell it, so altogether I'm going to get the option premium $8.4. So it's $1.40 higher, not $2.40, but 40. So, and that will give me 21% return. So because I invest only $6.95, I sell it at $8.40, I'm going to get 21% return. So that might last only for a couple of days. I've done it few trades like that in January, and some of them gave me 100% return within 3 weeks. Guild, I bought it at $7, sold it at $14, made 100% profit. And I presume some of you could maybe tell me similar trades. Okay, guys, is it clear here how it works? Again, if you don't understand, guys, it's better not to do that. Okay, it's risky strategy. Never use all your portfolio for that. But at the same time, that's how option traders, they make a fortune. Okay. Okay, Dory, very good question. And that's my next slide. You actually asked the question just before I continue. What's the risk here? The risk is here that it's going to stay below $100. And in this case, you need something. You have to have a plan B. All right, and Dory straight away thought about this plan B, and B is diagonal or calendar spread. The difference between diagonal and calendar spread, that calendar spread, you use the same strike price. So you use, in our case, $100. If you use diagonal spread, you can use different strike price, 101, 102, 105, or below that. Okay, I'm just going to show you with the same strike price, 100. So what it means, when we look at BR strategy, we buy shares and then we sell the call, we rent them out. In this particular case, we buy call, so we have a right to buy shares at $100, and then we sell call. So we promise someone that we can't sell them the share at $100. There is a certain risk with this strategy, but at the same time, look at the profit. So right now, if we do it for next month, for 31 days, we're going to get $1.85. Okay, so if you use our investment 6.95, it gives us 26% return. And the break-even price, so if the share price stays below $100, that's what we're looking for. So we do it only if we believe that the share price is going to stay below $100. Okay, we're going to get this price reduced. We paid $6.95 minus $1.85. The price of that specific option is going to be $5.10. Okay, how many times we need to do that in order to bring this cost to zero? How many times? 4 times only, correct. Only 4 times. And if we do it right, sometimes you can do it within a couple times. So imagine if you buy it and then the share price goes to $104. So instead of selling the call itself, like here, you sell in the money call. So in this, or if you go to 110, that you will get $10. It would be doubled. You can already do this stuff as well. Some people are afraid that it grows up and they're going to be called out. The interesting thing here that the volume of that call is going to increase. There will be some time value there. So you're not going to lose $5.10. There would be time value. And what you can do here, rollover strategy. So you can buy this call back when its cost like time value is 0 and sell the next call for next month with some kind of time value. So you do rollover strategy. Have a look at the rollover strategies in a new platform. I don't know, guys, did you have a look at recordings how to use interactive broker platform, which are recorded or not? Did you have a chance to look at this? Is it all clear there? No? Not yet. Okay. So I explained how you do rollover. So when you buy call and then sell another one, there is there. And so also I put some puts, how to do the puts. Because what I'm saying that imagine that it went to $105. This call would cost much more as well. And there would be time value there as well. It wouldn't be $5, it would be maybe $7 or $8 in price. So $3, maybe not $7 in time value, but maybe $4, something like that. Okay, that's why when you can sell it at $7, you're still making some profits. But again, so guys, probably we'll look at this strategy some other time. If you know how it works, you can do it. If you don't, better stay away.